You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it is time once again for TWIFO, This Week in Futures Options, the program where the name pretty much says it all. We break down the week that was and indeed still is, from a futures options trading and trending, an analysis and unusual activity, all sorts of perspectives. Going to talk about the volume, the volatility, the skew, the OI, all that good stuff, and a whole bunch more. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever scintillating, at least we think so, Options Insider Radio Network. Hope so all of you are out there enjoying double pro week on the pro side of the fence. At 2 pro Q&As earlier this week. Got Options Oddities coming up later this week at Double Dose OPR. Boot camp thrown in there. A lot of great stuff for you folks on the pro side. If you don't know what the heck I'm talking about, check it out. Theoptionsinsider.com/pro is the place to go to learn more. And, of course, keep those questions and comments coming from all of you. We love you out there. We love to hear from all of you. And let's see who we're hearing from on the old program today. Joining me, I'm pleased to say once again, it's been a while, Mr. ERIK NORLAND, the Executive Director and Senior Economist over there at CME. Mr. ERIK, welcome back to the program, sir.
Thank you very much for having me.
All right, ERIK, I'm excited to do it. Let's kick it off the way we always do with our movers and shakers report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everybody, welcome to the Movers and Shakers Report. This is, of course, the portion of the show we break down everything that's lighting up the tape to the upside, a.k.a. the light side, and to the downside at CME this week. ERIK, where should we begin our journey this week, sir? To the light side or to the dark side?
I think we should go to the dark side.
Ooh, I like it. I knew I liked you, ERIK. I knew there was a reason where I like the cut of your jib. Another dark side, man. I can get behind that. All right, let's get out there. By the way, listeners, if you want this chart, we usually tweet it out. And folks at CME usually tweet it out as well, so you can get access to it before the show if you want to see it for yourself. If you did so, you'd see it's a pretty evenly split week with the exception of the top of the light side. That is blowing the doors off. But other than that, it's pretty equal in both directions. Number 5 to the dark side, so the bottom of our bottom 5 there. We got soybeans off about 3.25%. Number 4 is silver, off around 4.25%. Number 3, back to the ag, soybean oil off 5.38%. Number 2, livestock, lean hogs off 5.89%. And our number 1 to the dark side this week, out to the metals, it's platinum off 6.62%. It was number 3 in the other direction, up nearly 6.5%. So kind of giving back everything that it gained last week. Moving on out to the light side, we've got number 5, it's wheat, up 2.12%. Number 4, rough rice, up 2.35%. It was number 5 in the same direction last week, up 5.25%. And wheat was number 2 last week, up 7.25%. So good weeks for both of them, but not quite as aggressive as last week. Number 3, Bitcoin, up nearly 3%, 2.9%. That's a bit of a rounding error in the Bitcoin world. It was number 3 in the other direction last week, off just a tick under 4%. Number 2, nat gas, up an impressive 8.5%. And number 1, with an aggressive bullet this week, an even more impressive lumber, up 31.65%. It was number 1 in the opposite direction last week, off 27.38%. So, man, this lumber continues swinging around. Good thing Sean isn't on the show today because his fence just got a lot more expensive. Good thing he locked in those lumber rates. And Erik, you know I enjoy having you on the program because you always come armed with a slew of research. We like to go from most recent and kind of kick things off there. I know you've been looking at the equity space a lot lately. So let's start there as we head on out into the equities.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everybody. Welcome to the equities. Erik, you've been crunching a lot of numbers out there in equities land of late, including very recently you have talking about the dividends, expectations for dividends to decline, not just this year, but beyond into the 2020s. And then, of course, some other interesting stuff going out a little bit beyond just S&P 500, looking at broad U.S. markets and some of their correlations or perhaps lack thereof to the emerging markets, in particular China. So, Erik, catch us up. What's been lighting up your tape on the research front in equities of late, sir?
Well, so we've done a lot of research recently on dividends, including the S&P Annual Dividend Index Futures, which is a huge mouthful, very difficult to say correctly. But it's a very, very interesting set of futures contracts. It goes out 11 years into the future. So it prices where investors believe dividends are likely to be between now and the end of 2031. So it's kind of like a yield curve, but for dividends instead of for interest rates. And what's really interesting about this is the market currently prices no growth in dividends for the entire coming decade. It doesn't say no growth, but like 15% growth over 10 years. That's like 1.5% per year. And it's actually negative growth after anticipated inflation. But what I think is really interesting is people now are so worried about inflation. And if inflation begins to rise, dividend payments are a potential source of return for investors. So that's, I think, one thing that's really interesting to look at. The equity market more broadly has taken a little bit of a correction earlier this week with the market sort of waking up again to the whole Delta variant issue. But it seems to have calmed down again later this week. There's just a lot of liquidity out there. The Federal Reserve is still buying $120 billion worth of bonds every month. And that's injecting huge amounts of money into the financial markets. And some of that is finding its way into the options markets, I think, and sort of suppressing volatility. But there is a growing worry, and you see this in those treasury options, of exceptional volatility in 10 years and 30 years. And so we've seen somewhat of a rise in the cost of those options. A few weeks ago, we had 30-year options at 7.8% implied vols. Today, they're trading at 10.4%. The 10-year treasury options, they had gotten themselves down to 3.7%. Now they're heading back up towards 4.8%. So the fixed income markets are showing a little bit of nervousness about this rising inflation trend. And I think that rising inflation trend is going to be a really, really big topic of discussion for investors in coming months.
Yeah, it's kind of inescapable. It's been behind the resurgences in a whole variety of product areas, including crypto and a bunch of others, as folks have been flocking to some assets I think will perform better in an inflationary environment. Getting back to equities here quickly, here's looking at some of your analysis, Erik. I think this just came out right before showtime. So hot off the presses, Erik, you have a paper called Drivers of Equities in China and Emerging Markets. And you point out since the beginning of 2004, the U.S. indices and what we're seeing over the emerging markets, the FTSE emerging market and the China AH50 indexes have been broadly correlated overall from a total return perspective. But when you start breaking it down a little bit more, you start looking at what's been going on in the FTSE emerging markets, you compare it to the S&P 500 and the Russell 2000 here in the U.S., those correlations tend to fall apart a little bit. And as you point out here, correlations between U.S. and Chinese shares have not always been positive and have averaged around 0.3. So walk us through that a little bit, because it's not an area we often get to analyze here on the show. We talk a lot about FTSE Russell and U.S. equities, but not how they correlate with the international market. So Erik, what were some of the interesting takeaways from your research in the equities today, sir?
Well, I think what's interesting is that sort of broadly speaking, emerging market equities do correlate fairly strongly with U.S. equities, not perfectly by any means, and the correlation is certainly unstable. It goes through big, big dips, especially after the 2016 election when there was a lot of nervousness about the U.S. trade stance. And the emerging market equities are also can also get knocked around a lot by commodity prices. So, like back in 2015 and 2016 when commodity prices crashed, there was sort of a divergence between their stocks, many of which are in sort of natural resource dependent economies and equities in places like the United States. But what's interesting in China, though, is their market is really not as highly correlated with ours, and it's been a big outperformer. I think part of the reason why it's a very weak correlation is because its sector weightings are really, really different. For example, the S&P has about a 28% weighting to technology stocks. So technology is kind of the biggest component of the S&P. That's a 3% weight in the FTSE China AH50. So you have a really big difference there. In China's AH50, the two biggest sectors are financials at 37% and consumer staples at 28%. So in the S&P, for example, financials are 11% and not 37%, and consumer staples are only 6% rather than 28%. So you just have this really different industry mix. But China's markets in general, I think, have been doing extremely well. In part because China has just demonstrated this phenomenal growth. I mean, their economy has been growing at 6.5% per year compounded, out over a long period of time. That's a much, much faster growth rate than the U.S., which pre-pandemic was in a good year kind of doing like 2% growth.
Well, let's break down some of that here. You mentioned, the correlation with the Russell 2000. When we're talking equities, we always like to look at the flip side of that coin, which is volatility. Some interesting developments out there since our last show, even though RVX kind of staying glued at around that mid-20s level. RVX, of course, the VIX of the Russell 2000 listeners, coming into showtime was just a tick north of the 26 handle. That puts it down about 0.2 of a point from last week. So pretty much unched right around 26 and change. VIX cash coming into showtime was almost exactly unched from last week. It was a almost 1770, which pretty much was where it was this time last week. VVIX at about a 118, almost 119, puts it down about 4.6. That's, of course, the volatility of volatility, listeners. And vol Q, aka the at the money vol of the NASDAQ 100, was at nearly a 17 even. That's down about almost 1.75 points from this time last week. So that puts that VIX to RBX spread, aka the small cap to large cap spread, similar to where it was this time last week, right around 8.5. That's a little bit tighter than last week, but not much. And the VIX to vol Q spread at about 0.6 of a point. That's over half a point tighter than what it was this time last week. So a little bit of evolution on the vol Q front as we're seeing NASDAQ vol moving around a little bit. And in terms of what's lighting it up out there in the options this week, FTSE Russell, you can find this for yourselves, listeners. cmegroup.com/TWIFO or /TWIO is the place you want to go. Go to that drop down, go to the equities, go to the Russell 2000. Russell 2000 small caps have been on fire this week. A ton of volume hitting the tape, almost 45,000 contracts already coming into showtime, which is a lot out there for this time of week. And then looking at what's been lighting up the tape, of course, you've been listening to the show for a while. You know it's the weeklies going out tomorrow that are dominating the tape with nearly 30% of the paper. By the way, the Russell 2000 right now at pretty much exactly 2,200, 2,201 to be precise, up nearly 2% on the week after selling off pretty aggressively at the beginning of the week. And in terms of, so we have to go a little bit farther out, listeners. We'll go out to a whopping 8 days. You know, I like to go out 2 weeks to make the skew and the vol make a little bit more sense, but we have to do what we have to do in the equity. So we'll go out a whopping 8 days to see the most active contract actually is the contract expiring in 8 days, the 2,200 put. We don't see this too often. The at the money option is what's dominating the tape in the FTSE Russell this week. Usually it's some, as you guys like to ask about, the small delta calls or some far out of the money puts. This week, it's your straightforward 2,200 put, did about 3,000, all that opening yesterday and about almost 3,000 and going up again today, total of nearly 6,000 just on that one contract. So that's a lot for an at the money contract in the Russell 2000. Usually we see, like we said, a little bit more playing on the skew front. We did see some of that this week, but not as much, obviously. 1760 puts going up out there in August. We're number 2 with about 1,500 of those bad boys. Skip the skew before we get to that. Let's skip the vol and the skew. Let's go back out to that 8-day contract. The vol, if you're wondering out there, remember RBX is more of that, aggregate 30-day measure. That's in the mid-20s, and the 8-day contract also still in the mid-20s. Right around 24.35, off about $1.50 when it comes to vol. Skew-wise, remember, take these numbers with a bit of a grain of salt because you're talking about the weekly, so the skew is a little bit of a moving target out there. But the puts last week, 11.1% rich. This week, about 8%. So they've come in a little bit, still bid. Calls last week, 8% cheap. This week, 8.6% cheap. So calls not really moving much. Puts coming in a little bit. And again, a lot of that action on that at the money strike. So again, not really moving in the call wing or the put wing. 1760 puts out there in August, number 2. Those were pretty active. And then the 1710 puts. So there were some farther out of the money puts going up this week as well. That's kind of what you'd expect in the Russell 2000. But beyond that, all at the money all the time. That's kind of interesting. Erik, we can probably hang out in equities for a while, but I know you have some other research burning it up, and looking at our movers and shakers, the metals were burning it up this week as well. We had silver at number 4 to the dark side, off 4.25%. And platinum was our number 1 dark side mover this week, off 6 2/3%. So let's head out to the land of the metals next.
Werewolves beware. It's time to explore the options activity in silver, gold, and other shiny things. It's time to talk metals.
All right, Erik, I know when you're not talking to me, you're doing some other podcast called Off the Charts. We don't acknowledge the existence of other podcasts here on this show. But if we did, we would mention that you've been doing some interesting analysis out there in the metals, in particular the gold equities nexus, and also looking at some of the vol in copper out there, Mr. Erik. So why don't you catch us up on some of your metals research, and we'll just ignore the fact that you've been going off on your own podcast, sir.
So let's start with copper volatility. I mean, copper is one of the assets where volatility has not really declined all that much. We've seen in many different instruments, like in the S&P, the NASDAQ volatility's come way down from where it was previously. It's even true in precious metals like silver and gold. But copper has kind of stayed up there in terms of volatility. And I think that there is just a lot of nervousness in copper about the degree to which the price of it advanced. Copper has been the gigantic outperformer among the three biggest metals contracts here. It has corrected a little bit off its highs. It peaked out around the 10th of May at 489 cents per pound. Now it's down to 433. But this is a metal that was trading at 197 when things hit bottom in March 2020. So it's still up over 100% off of its low from last year, and it's come up to basically a record high. It's gotten right back to where it was in 2011. Which is a pretty spectacular return for it. And I think this has happened really for one major reason, which is during the lockdowns around the world, people were not able to spend money on experiences, but they were able to spend money on manufactured goods and on home improvement, all of which was to copper's benefit. And so now I think the question for copper is, given the higher prices, that start destroying demand. And also, now that things are beginning to reopen in many parts of the world, are consumers going to shift their spending away from manufactured items and back towards experiences like vacations? So does that mean maybe less demand for copper and maybe more demand for oil? And so kind of caught in the middle here are things like silver and gold. Silver and gold are both off of their recent highs as well, but a little bit more sharply than copper, and they didn't really perform as well as copper. Like copper went up over 100%, almost 150%. Whereas gold prices went up more like 40% or so. Silver had a spectacular gain too. It had a gigantic rally versus gold, but that seems to have sort of petered out now as well. And so I think the question is, do gold and silver maybe start gaining a little bit more interest as an inflation hedge? What I think is remarkable about this whole inflation story is that everybody talks about it, but the markets don't price it. We have seen in the second quarter, if you just look at the April, May, and June inflation numbers and you annualize them, we were running between 9 and 10% annualized inflation, and yet break-even inflation spreads on bonds, on TIPS versus standard U.S. Treasuries, they show 2.25% inflation for the rest of the decade. You have 30-year Treasuries trading at 1.9% yield. Clearly, a total lack of concern about inflation, and that lack of concern about inflation for the moment seems to extend to gold and silver prices, which really haven't been gaining on this. So I think this whole inflation story, if it persists, could still come as a really big surprise to markets if we continue to see strong incoming inflation numbers. So that could be a really interesting thing to watch for precious metals and for treasuries and maybe even equities too.
Well, let's get into it a little bit. We don't usually talk about copper. I mean, it is a growing options story. I know when we first started this show, it was an anemic options volume trader. These days, doing a little bit more paper out there. Not quite, almost 8,000 contracts. Doesn't sound like a lot, but then again, compared to where it used to be, a few hundred to 1,000, that's actually up quite a bit. Copper right now coming into Showtime. By the way, listeners, you can find this for yourself. CMEgroup.com/TWIFO or /TWIO. Head on out to the metals. Skip on past the precious where we normally hang out. Go out to the base. Copper is right at the top there, listeners. You'll see this for yourself at about 433 coming into Showtime. That's up about almost 1/3% on the week. The most active contract of that 7,000, so use active in air quotes, is the SEP contract, about half of the paper going up out there. If you're wondering, copper vol about 23 1/3 off, a little over 2 points, about 2.2 points this week. Skew-wise, last week the puts 8% rich. This week, 2.6% rich. The puts coming in a little bit. The calls last week, 5.4% cheap. This week, 2.4. So the calls getting a little bit of a bid. The puts coming in pretty aggressively, actually. In terms of what the action was, it was the 4 even puts doing a whopping 617 contracts. That was the number one trade out there. So interesting stuff in copper. Erik, I know you also like to look at some of the precious as well. You were just talking about gold and silver and their interaction with the equity. Since we have silver dominating our dark side this week, let's head on out to silver next. For that drop down, listeners, go back out to the metals, go up to precious. and then you're off to the races out there. Coming into showtime, we have silver at about a 25.5 off, almost 1.2% since Monday here. In terms of where the action was this week, it was actually in a weekly. It looks like it was in the AUG contract that has a whopping 5 days to go. 35% of the paper going up out there. Interesting. We're going to go a little bit farther out. We're going to go out to September. That contract has about 35 days to go, and that has about 22, almost 23% of the paper. So we'll hang our hat out there. Even though the vols on both of them are pretty similar. It's about a 25 on that weekly and about 24 3/4 in the SEP contract. By the way, if you're wondering how much paper silver does compared to copper, copper was right around 8,000 contracts, and right now silver's at about 27,000 and change. So a little over 3x out there in silver land. And in terms of that contract we were just talking about, that SEP contract, the vol 24 3/4, up nearly half a point this week. The skew last week, the puts were 3% cheap. This week, the puts are about 2% cheap. So not a huge evolution on the put wing. The calls 5.3% rich last week. This week, 7.4% rich. So catching a little bit of a bid on the calls. In terms of the most active contract, though, it was going back to the weekly that's expiring in about 5 days, the 25 put, doing over 1,000 contracts out there. So that was close to the number one. We have just barely getting beat, going all the way out to Dees, the Dees 20 put, doing 1,151 to just barely take the crown by a few contracts here. And that was pretty much all on Monday. 1,100 of those puts going up. Also worth noting, about 550 of the 19 puts and 395 of the 18 puts. So if it was a fly, it's a bit of a weird one. Maybe the 1920 1 by 2. Either way, all of that was opening on Monday, not much trading the rest of the week. Followed right behind it by the 25 puts out here going out in the weeklies in about 5 days. They did 1,100 contracts as well. The big day was Monday, a whopping 600 going up there, a good chunk of that closing. So interesting stuff in silver. And since you mentioned gold, Eric, we'll do a metals trifecta. We'll head on out to gold. Gold is the most active, obviously, in the metals options these days. Again, go back to that drop down, stay in precious, go back up a tier to gold, and you'll find what I'm talking about. We're talking about 27,000 contracts in silver, 123,000 up right now in gold so far this week. So a little bit more active. Gold threatening the 1,800 strike right now, 1,807 coming into showtime, off about 0.5% on the week. And similar to silver, the contract expiring in 5 days, that weekly, has about 37% of the paper out there. So interesting. Very near-dated paper in both of these metals this week. In fact, I'm hard-pressed to find another month that comes even close. If you go out to September, the monthly, it has about 16.5% of the paper. So I guess we'll have to go out there because it's hard to analyze a contract that has 5 days to go, but that is where a lot of the paper went up. Let's go out to the SEP contract, 16.5% of the paper this week. Let's see the vol out there. Metals vol is always pretty anemic, and it's once again anemic, about a little bit shy of 13, off about 1/3 of a point. Skew-wise, the puts last week, 2.6% rich. This week, about 1.6% rich. And the calls last week, 1% bid. This week, 3.2% bid. So a little bit of a bid creeping in to the calls, but not much. In terms of the most active contract, it was the 18.5 calls that are going out in about 5 days. Did 5,000 contracts this week, 5,100 to be precise out here. So that was the most active contract. 18.5's also active out there in September as well. So it appears like the 18.5 strike had some fascination for folks. 18.5's trading 1,800 on Monday, 1,600 on Tuesday, and about 1,500 today. So trading pretty actively throughout the week. Obviously, as we threatened that strike, then are now below it. It was maybe an out of the money, then an at the money, and now an in the money strike throughout the course of the week. And we're seeing commensurate paper going up as a result out there. And we like to look a little bit farther out in gold. There's always something funky afoot out there a little bit farther out. If you like pessimistic trades, 1,400 puts going up this week as well. All of that today, 1,400 puts, 2,500. Obviously, I don't have any opening or closing. We don't know if they were selling or buying. So they could be loading up on the 1,400 puts to the downside. They could be blasting away at those as well. Also worth noting the 1,500 puts in Dees trading as well, but only 1,000 of those. So it'd be a weird ratio if it was a bit of a ratio spread. But we're not seeing our usual slew of call flies going up in the longer term in gold, which maybe in and of itself is somewhat informative. Eric, we've talked about gold, we've talked about silver, and even copper Anything else you want to add in the world of metals before we move on into our next product category, sir?
It's not a lot I have to add, but this is way too early for options, I think. But I would point out that we now have lithium and cobalt futures on the exchange. So that's something to think about for the future.
Futures for the future. I like it, sir. Well, I know you've also been doing a little bit of interest in ags of late. I mean, who can blame you? It's one of the hottest complexes out there. So let's hang our hat there next.
It's time to get our hands dirty exploring the latest options trades and trends in corn, wheat, soybeans, and more. It's time to talk ags.
Well, Eric, another one of your recent papers out there, Ag Market Signals, some of the futures and the options, kind of pointing out that corn and wheat options are the most expensive they've been in nearly a decade, and corn, wheat, and beans see risks being skewed to the upside. Again, seeing that playing out in the options, and talking about how you can analyze the futures curve and compare that and contrast that with the options data to find some interesting signals within the noise there, Mr. Eric. So what's lighting up your tape out there in the world of ags these days, Eric?
Well, I wrote that paper, I think, a little bit over a month ago. And basically its point was to, kind of say the futures curve is sort of like the center of a probability distribution, whereas the options give you a sense of how wide that distribution is. And when I wrote it, it was right around the highs in corn, wheat, and soy options, which, as you know, got to pretty astonishing levels. We got corn options to go up to 55% implied volatility, levels that we had not seen since the global financial crisis. Wheat options were the least extreme, but they're still up around 35% implied vol, which is close to their highest levels that they would get to since 2012. Like, you would occasionally spike up there, but their mean levels are kind of maybe 10% below that or so. And we got soy options, briefly up to the mid 40s, which was their highest since 2012. So the markets are just giving these incredibly wide probability distributions, saying that the most likely path for agricultural goods along the forward curve was for them to decline in price, which indeed is what's happened so far. We have seen prices come off. But around that expectation, it was just miles wide, basically saying anything could happen. Anything from going down to, sort of 1990s low level prices in soybeans, corn, and wheat, all the way up to unprecedented record highs, and anything in between. And I think that is really, I think what's going on in ags is really a reflection of the extreme weather conditions that we've been seeing around the world. We've been seeing just crazy things happening. Like in Zhangzhou, for example, where a city I visited in China a few years ago, which is where one of our sort of colleague exchanges is. It's where the Chinese corn market trades. In that particular city, they got 7 inches of rain in a matter of like an hour, flooding the entire city in a way that was very similar to what happened recently in Germany. Of course, you have the big fires out in the western United States and also in Siberia. But what's really been driving the ags are drought conditions in South America, somewhat drier than normal weather in the Black Sea region in the Ukraine and Russia. And of course, somewhat uncertain conditions and drier weather in parts of the United States. And so we've been seeing all of these things really, I think, unnerving people in the ags market. And I think that those sort of miles wide distributions are a reflection of the fact that we could, suddenly have perfect weather conditions and we have bumper harvest and prices crash, or we have some really terrible events like we've been seeing around the world that drive prices up to record highs. And this, I think, is a really astonishing situation that we find ourselves in.
Well, speaking of astonishing, let's get away from the traditional ags just for a second. I mean, it's not the most liquid of options product. In fact, doesn't really do any options paper at all. The futures trade, I'm talking, of course, about lumber here, Eric. It's been just moving all over the place for the better part of the last few months. This week, once again, off to the races, up 31, nearly 32%. Who would have thought when we came into this year? We kind of expected maybe Bitcoin to be active and a few others, some of the hot tech names out there in the stock market. But whoever would have thought dead trees would be perhaps the most active, most volatile commodity of them all? Yet that's where we find ourselves right now. I have to imagine, again, it's not the most liquid of options products, but I have to imagine you've been keeping your eye on this. What are your thoughts on just the insane swings we've been seeing in lumber of late, Erik.
Right. So this is very much, to my mind, in the same category as copper. So people have been able to spend money on manufactured goods, which sometimes involve lumber or pieces of wood, and they've been able to spend money on housing and home improvement. So we've seen housing starts and building permits increasing quite rapidly. Home prices are rising very rapidly. But people are also doing a lot of home improvement, adding extensions to existing houses, et cetera. And so the problem in the lumber market is that prices have remained low in lumber for quite a long time. Prices had kind of gone nowhere in this commodity. It was, not a particularly exciting market that people talked a lot about for a long time. Basically between like 1992 and 2020, prices generally stayed in a range. It didn't really move all that much. But the key constraint here in lumber is sawmills. There are plenty of trees. And oddly enough, the price of trees or even dead trees themselves, like in their raw form, actually has not changed. Lumber, of course, are trees that have been cut apart in a sawmill into, usable boards, like 2x4s, things of that nature. That's what we define as lumber. And the constraint here is that the sawmills have run out of capacity. There are tons of trees, but the sawmills can't process them all. And so this has created a tremendous amount of volatility for the final product. As people have rushed out to buy lumber, but the sawmills can't keep pace with it, with the demand.
Lumber mills, the hot new thing of the 21st century, Erik. Who'd have thunk it? What's next? Buggy whips, sir? Buggy whip manufacturers going to come back in fashion? Here we are, lumber mills. A good business to be in, at least for the next couple of months out here. Let's look out to the ags and see what's lighting it up. Like we mentioned, Erik was just talking about the beans, and the beans are also on our dark side, number 5, off about 3.25%. And one of the ag volume leaders out there by way of comparison, beans doing about 222,000 contracts right now, so a pretty active product out there. Soybeans at about 14.1625, off about 38.5 points right now, or about 2.65% on the week. In terms of where the action was, the beans tend to be, and the ags in general tend to be a little bit more longer term perspective on the options. They don't all just flock into the weeklies the way they do in the equities out there. And that's the case again this week. We're going out to the NOV contract. That's about 36.5% of the paper went up this week. If you're wondering out there, that future's at about a 13.62, so a little bit lower than that front contract. The vol out there is at about a 27.20, off about half a point. Not a huge move from a vol perspective. In terms of skew, last week the puts 7.1% rich. This week, actually, I'll take that back, 6.1% rich. And puts this week 10.2. They were 6.1% cheap last week. This week, 10.2% cheap. And the calls last week, 9.6% rich. This week, 9% rich. So not a huge move in the calls, but a puts getting a little bit cheaper out there in the NOV beans. In terms of what was the most active option this week, it was the 1,500 calls in November, and the soybeans doing 9,200 contracts this week. Pretty active throughout the week, even though the big day was today, 4,200, so nearly half of that going up today, 2,500 yesterday, and the rest kind of scattered throughout the week. Pretty much opening throughout the entire week. We don't know about today's paper, obviously, but still a lot of paper on those 1,500s, followed behind it by, looks like it was the 1,600s doing about 5,700 contracts this week. The big day again today, 3,000 going up today. So a pretty active day out there in the beans. The 1,500 strike seemed like it was pretty popular across the board. Also saw 15 halves going up out here in September, with about 8,500 going up this week of the 15 half calls. The big day was yesterday, 4,500 of those, 2,000 today, and about 1,000 on Monday. The rest kind of scattered there on Tuesday. So interesting action, pretty much all calls all the time out here in the beans this week. Let's look really quickly. Any other ags lighting it up out here? We can look at wheat really quickly. The wheat is, again, not the most active of contracts. Wheat was up 2.12% this week, but it does some paper. I mean, you're talking roughly half the paper we see go up in the beans, maybe a little less, about 108,000 contracts up in wheat right now. Let's, again, go out to the drop down, go to ags, go to the SRW wheat. That's where we're hanging our hat next, listeners. That contract's at about a 692 coming into showtime off about a quarter of a point. So it's effectively unched, which is kind of interesting. So again, looks like most of that move came since our last show last week. That's what the movers and shakers report mentions or measures. It goes all the way back to the end of our last show and compares it to where it is now. Whereas the this weekend obviously starts at the beginning of this week and goes forward from there. And in terms of the paper, I said about 108,000 contracts on the tape. 41% of that coming in the September contract has about 36 days to go. So we're going to hang our hat out there. The vol there, 33, a little bit over 33, off about 2.15 points this week. So still pretty frothy out here in the ags. I've said it before. I'll say it again. If you're looking for volatility, you're an equity options trader, and you're kind of maybe you want a little bit more than the teams that they're giving you right now, then maybe the ags aren't the worst place to look. In terms of skew, the puts last week, 5.3% cheap. This week, 7.3% cheap. The calls last week, 6.1% rich. And this week, 9% rich. The calls getting bid up, and it seems like the most active contract out here was in the calls, but it was in actually the weekly going out tomorrow, actually. 720 calls with 3,200 going up this week. That was number 2. Looks like the 7.5 calls in September, the 750 calls were number 1 with about just a tick under 5,000. The most active day was yesterday, about 1,800, 1,400 on Tuesday, and about 1,000 each or close to it on Monday and today. So 7.5 calls in September leading the dance. Again, those are fairly out of the money. So an interesting strike to break down out here. And we could keep talking ags and other things, Erik, but I got a feeling the listeners want to get at us a little bit as well. So without further ado, let's head on into the futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's Mixlr.com.
All right, everybody, welcome to your feedback segment. Erik, looks like the folks are excited to have you back. We have Nichols, one of our pro members in the live chat. He says, excited to have Erik back on the show. I haven't heard from him in a while. He always brings good information with him. So there you go, Erik. The folks are excited to have you back on the show, sir.
Well, I'm excited to be here, so thank you.
All right, next up, we have another one of our pro members, Options Queen. She says, what are Erik's thoughts on Bitcoin and Ether right now? Does he have any research to share on that subject? You knew crypto was going to come up, Erik. People have it on the brain these days. A rare, somewhat quiet week for them. A 3% move in Bitcoin is kind of a bit of a rounding error compared to what we've seen out there of late. But it has been a fascinating complex to watch since the last time you joined us, which I do believe it has been a while. There's been some pretty impressive moves out there in that complex. What's lighting up your tape? And as Options Queen puts it, do you have any interesting research in that area to share with us, sir?
Yeah, I do actually. I have some research on it that I think is really pretty unique, and I think would be useful to people who look at cryptocurrencies. And so I can't remember exactly the publication date for the most recent paper, but I would say it's probably late May, early June, and I think it's still very, very fresh and relevant. And so first of all, when it comes to Bitcoin, the argument that it makes is that there are some incredibly important data series that I think investors who invest in Bitcoin should be looking at. And these data series are available for free on a website called blockchaininfo/charts. And there's just a ton of information on this website. But the most important piece that I think is really compelling and really interesting is the cost per transaction. So Bitcoin, as you mentioned, tends to be volatile. In Bitcoin's history, it has now had 4 major crashes. The first crash was a 93% drop. Nobody remembers this. It was back in 2010 or 2011. second major bear market, people may have a vaguer recollection of, happened around 2012, 2013. Then Bitcoin went from $1,200 to $200 per coin. And then the third major bear market happened the end of 2017 into 2018 and 2019. Bitcoin fell from about 20,000 to about 4,000. Was about an 82% decline all told. And then most recently, of course, we've had this 50% or more, almost 60% drop now off the high of 64,000, which we hit in April. What all four of these have in common is one thing, which is a massive spike in the cost per transaction. By which I mean the cost per transaction on the actual exchanges, which I hesitate to say physical Bitcoin, if you'll forgive that expression, are traded. So every time cost per transaction spikes, Bitcoin has subsequently crashed, and this last time has been no exception. Now, what I would add to that is very briefly is that when Bitcoin stages a major rally, usually it comes after a long period of much lower transaction costs. And what I would say is that we are not there yet. It doesn't mean Bitcoin can't go up. Of course, it can go up. But typically, at the moment, transaction costs for Bitcoin are still pretty high compared to where they were historically. So we haven't come down to these low levels of trading costs that in the past have sparked rallies. Also on the same website, two other important pieces of information, not quite as compelling, but one is the number of transactions per day. Usually Bitcoin rallies happen when the number of transactions per day has been increasing. So rising volume, usually in the past anyway, has correlated to strengthening Bitcoin. Recently, we have seen falling volumes, and typically that has been associated in the past anyway. No guarantees about the future, but in the past that has often been correlated with declines in Bitcoin prices. So I think what's going on with Bitcoin is there is a regulatory crackdown going on in China and to some extent in the US even, in other countries. This is reducing the number of people who are using the currency, and that has put a sort of bearish tilt on it these past few months, which in combination with the high transaction costs are making it difficult to use Bitcoin. Ether is a somewhat different story. The Ether market has been healthier than Bitcoin. It seems to be gaining on Bitcoin in terms of market share. Ether prices have also come off their highs. They've gotten knocked around a little bit. But Ether is undergoing some changes internally. It's sort of had, in the past, it was sort of proof of work in order to create new Ether. Now it's going to be more like proof of ownership. So there are some changes going on in the Ether market. Ether is a smart contract market, and it's very different than Bitcoin. I would say that Bitcoin is sort of more like the precious metal, if you will, of the current cryptocurrency universe. It is a volatile store of value, sort of like gold is, but much more volatile than gold. Whereas Ether is a bit more like an industrial metal. It actually has real uses that you can use Ether or the Ethereum network for to create smart contracts. That are kind of maybe a little more practical than the store of value concept of Bitcoin.
I like that analogy, the precious versus the base type metals out there. Because we always hear, Bitcoin is digital gold. That's bandied about all the time. But I like the notion of Ether as more of the production type work metal. I like that. Interesting. Let's keep on rolling here. Connor has a question. Connor says, I very much enjoy the futures options content on your network. Well, thank you, Connor. He says, I recently came across this chart from the Wall Street Journal, and I immediately thought of your program. Does this jive with what you're seeing out there across the markets? And he shared a chart of cross-asset implied volatility, and the chart was titled Implied Volatility Across Markets Has Fallen Below the 3-Year Median. Looks like they charted levels of the percentile of volatility, where they fell in the percentile over the course of the past year. And it looks like for most of these commodities and these products they're talking about here, the apex was a year ago, and it has fallen steadily ever since. So they have currencies here, for example. A year ago, they were in the 69th percentile, so obviously much higher volatility. And coming into I think this chart goes through June. Coming into June, they're at about the 17th percentile, so obviously much lower. Rates, a similar story. A year ago, they were in the 80th percentile, now at the 37th percentile. So also much lower. Oil, a year ago, 91%, and they also have it broken down by March and May. You can look at it all the different segments if you like, but and coming into June, it was at 31. The S&P, so a year ago, 94th percentile from a vol perspective. Right now, well, coming into this chart at least, at the 40th percentile. Let's see, emerging markets equity, a year ago, 91%, now 34%. And let's see, high yield corporate bonds, a year ago, 91% as well, and coming into June, 9%. So, yeah, this does kind of jive. We have been talking about this for a while, outside of some crazy assets like Bitcoin and lumber, of course. Then actually notice they don't have ags on this. I imagine ags would be one of the few that might buck that trend, because of late we have seen a little bit more vol out there in the ags space. But aside from that, aside from the ags and a few others, it does seem like the trend has pretty much been lower. And that's something we have been talking about on the show for quite some time. Erik, does this, as he puts it, does this jive with what you're seeing out there with the markets as well? For the most part, again, maybe ags being the exception and maybe crypto, we have seen a general decrease in implied vol across the products, sir.
Yes, absolutely. We see that in energy. We see it in gold and silver in particular, a little bit less so in copper. We certainly see it in the equities. And at least up until the last week or two, we started to see it in fixed income. But the fixed income market in the last couple of weeks is starting to turn the corner. And I think that might be, the last place we see it, of course, is currencies, where volatility is just more abundant. But I think that we're coming up on some very, very big risks here. And I think the big risks all center around diverging public policies in different countries and rising inflation. For the moment, the markets, I think part of the reason why this volatility's fallen off is that investors have essentially bought the central bank's line that all of this inflation is just transitory. They have swallowed this story hook, line, and sinker. And the problem is, if it turns out not to be true, and inflation turns out not to be transitory, there's going to be a lot of markets that simultaneously will be in for a very rude awakening. So you could wind up seeing much higher bond yields. Higher bond yields in turn could provoke a huge sell-off in the equity market. The equity market is trading at extremely rich valuation levels that are predicated on this idea that inflation and long-term rates will remain low basically forever. And then, lastly, if inflation really heats up, it calls other markets into question. Do people then start taking a more serious look at gold, which has been a huge underperformer among commodities since this whole pandemic began? Really underperforming silver and copper in particular, but also a whole bunch of other things, lumber, corn, soybeans, etc. Do people take a more serious look at gold? And then lastly, it is sort of a test for Bitcoin. Is Bitcoin truly an inflation hedge? If inflation turns out to be more persistent than the Federal Reserve and other central banks, and apparently investors seem to believe it is.
Well said, sir. And I had the same thought about rates. I kind of wondered if you extended this chart a few more weeks into June, if you might see a little bit of that trend changing a little bit in the rates. Because you're right, they have been a wee bit more volatile of late. Unfortunately, listeners, that music means we come to the end of our journey here on TWIFO this week. I want to thank Erik for beaming in from across the pond to join me here today. Clearly, the listeners like it, Erik. We have to get you on more often than once every 6 months or so, sir.
Yeah, I think we were doing once every 3 months, but things have been so disrupted with the pandemic. But, the funny thing is, though, that the last time I was on, Bitcoin was almost the same price it is today. It's almost like nothing happened.
I know. I had another guest on our crypto program earlier this week, and he had it at the same time, but he hadn't been on since January. He said the same thing. He's like, nothing's happened. Bitcoin's right around 30,000 again. So, yes, a whole bunch of nothing has happened since then, Erik. I'm sure you've been very bored. Well, Erik, I'm glad you could join us again. Our listeners enjoyed it. And maybe before you go, you always have some cool things in the hopper. Maybe you can leave our audience with some hints, some teases of what they can expect coming out of you and the research team in the near future, sir.
Okay, we have a lot of research on inflation, diverging inflation trends around the world. Inflation's really heated up in the U.S., but it's not heated up much in Europe. And so one thing that kind of perplexes me is the incredibly complacent currency options market. And I get it. Currencies have been moving sideways, especially the majors like, euro versus dollar and yen versus dollar and Swissy and even the pound versus the dollar. They've been kind of headed sideways. The pound's an exception because of Brexit, but the other ones have headed sideways since 2015. But that's in part because everybody's economy was doing the same thing. From 2015 to 2019, we're all expanding. Then we all got hit by the pandemic. Now we're all rebounding from the pandemic. But the thing is, the pace of rebound is very different. It's very, very much faster in the U.S. There's much more inflation. The markets are now pricing the Fed's going to start hiking rates next year or the year after. There's no such expectation for the ECB. So when we start getting really big divergences in rate movements and inflation and fiscal policy and monetary policy between countries, that could generate a really big move in the currency markets. And I think that currencies have been so boring these last several years could suddenly become a very, very exciting place to be.
That would be interesting. We could actually feature them on the show again, Eric. I lost track of the last time we actually broke down some FX on this show because nothing happens. But perhaps, if you are correct, sir, perhaps we shall be talking about it again, and perhaps you'll be joining us to do it. So I'll look forward to that. In the meantime, of course, listeners, you know where to go to find all of Eric and Blues and everyone else's research over there. CMEgroup.com is the place to go. Go to /TWIFO and /TWIO for our reports. And when you're done with all your analysis there, head on over to the research and education tabs. And beware, though, it's a rabbit hole. Once you start clicking on some of Eric's papers, you're going to be there for a while. So stay tuned. Bring a beverage, pack a lunch. You're going to enjoy it. You're going to have a lot of analysis. It's going to make you think and say, I hadn't thought about it in that way before. So check it out over there. And you know where to go for all the research on all things small cap vol, large cap vol, everything else. FTSERussell.com is the place to go. Check them out. And while you're there, give them a follow on the old Twitters as well. At FTSE Russell, FTSE Russell is the place to go. And on behalf of Eric, everybody over there in CME land, and everybody over there in FTSE Russell land, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for listening live, for sending in such great questions. That's it for us today. But don't worry, we're back again tomorrow, noon Central, 1 p.m. Eastern, to break down everything going on in the world of equity volatility. And spoiler alert, it's a lot on volatility views. Then for all of you folks on the pro side, we'll see you back after that, 2 p.m. Central, 3 p.m. Eastern, to break down the crazy week of unusual options activity with Options Oddities. And we're back again with another week, all the way through to Thursday, another episode of This Week in Futures Options.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores.
Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.